Good morning. It's Jeffrey Christian of CPM Group. It's about 12 minutes after 11 here in New York on Tuesday, the 2nd of April. Gold prices are setting new records again today. It's gotten up. The June contract on COMEX has gotten as high as $2,297 this morning. It's about $2,285 as we speak. Silver has actually broken slightly above $26. It got to $26.03, and it's come back off a little bit since then. Platinum, palladium, copper, other things are rising too. It's interesting because in the 3 of the last 4 trading days, gold prices have set new record highs on an intraday basis. And over the course of March, as I said last week, we saw 3 new intraday highs. Record highs on gold prices. Gold prices continue to be very strong, and it's very interesting because we're seeing gold prices hang up and rise to record levels in a period of time where we're seeing relatively sanguine economic conditions. What we're seeing this week, and last week even, is that long-term investors who have been buying gold have been joined with short-term investors taking advantage of the rising prices, trying to get in on the price increases. And last week and this week, we've seen investors going into silver as well, having sort of focused on gold earlier over the course of most of March. So you're seeing strong investment demand in times of economic strength. We talked about this in last week's video, and you can go back and revisit it. I don't want to plow old fields there. But basically what you're seeing is anticipatory risk aversion. You have relatively strong GDP in the United States and a number of other countries. The UK has sort of gone into a technical recession, a 0.1% contraction in the most recent quarter, following a 0.3% contraction in the previous quarter before that. Germany is in a shallow recession right now. But in the United States, Canada, and other countries, you're seeing relatively healthy economic activity, strong labor markets still, slightly declining inflation, and high interest rates. And what you're seeing, our view is that investors are buying gold, the U.S. dollar, the U.S. treasuries as a risk aversion in the expectation that political and economic issues will worsen and become more hostile in the near future, especially the political environment, both domestically and internationally, is problematic. And the economic outlook is, well, okay, we're sort of at a very good level. Can we continue with this strength? Will fiscal constraints and fiscal dysfunctionality on the part of the U.S. government and other governments start to constrain growth? Will supply and demand conditions in various goods and services continue to or begin to exert stronger contractionary pressures on the economy? And the answer is probably yes. And investors are looking at that. They've done very well in the stock market. U.S. equities at record levels or near record levels. They've done very well in corporate debt. They're worried about the quality of that corporate debt. They're worried about financial counterparty risks. They're worried about commercial real estate and retail overcapacity and manufacturing overcapacity. They're worried about the political environment. They're worried about what could come. And it's like, okay, let's take some of these profits. Let's capitalize some of the gains we've made in stocks and bonds. And let's move some of that money into less risky assets. And gold is considered one of those less risky safe haven investments. The other one is the U.S. dollar, which is why the dollar has held up very well against other currencies right now, and U.S. treasuries. And we're seeing both foreign and domestic investors buying record volumes of U.S. Treasuries. No one's dumping the Treasury. They're actually running to the Treasury. Now, you're seeing some indications of this risk aversion within the gold market, and I'll show you a little bit. Now, in the last few weeks, we've seen speculators joining in with longer-term investors. All of the charts I'm about to show you are from CPM Group's April Precious Metals Advisory. That's a subscription service that we produce and sell to our clients. We also have gold, silver, platinum, palladium trade recommendations. We've come out with revised gold and silver trade recommendations this morning. We are coming out with platinum and palladium ones later today. All of those are subscription services that people pay CPM Group for. So I'll talk about where we think metals are going, but I may not give you as explicit of projections as we think. Again, as I said, gold prices set 3 record daily highs in March and 2 more in the first 2 trading days of April. So you're seeing very strong demand for gold. But who's buying that gold? That's the key, right? One of the things that we're seeing is about a 6 million ounce increase in non-commercial institutional investor long positions on the COMEX over the course of March. These are shorter-term investors who have seen the price rising based on long-term investors buying gold, and they joined the party. You also seen a decline in the gross short positions that institutional investors have had. You're not seeing particularly anything on the commercial side. Commercial shorts have risen, but that's basically because the non-commercial longs have risen. And if a non-commercial entity wants to go long a futures contract, a commercial has to go short. So you're seeing that. And the commercial shorts have not risen as much as the non-commercial longs, which is what you would expect because some of those long positions can be hedged in the over-the-counter market, in the forward markets, in the options market, and some commercials will actually use ETFs and ETF options to hedge their short position that they're taking when they match those, when they provide the short side of those long positions on the COMEX. Who's buying? There's been an interesting reversal during March in ETFs. It's probably a short-term phenomenon. You can see from this chart, ETF holders have been declining, selling off their ETFs really for 3 years now. They peaked in 2020, and they've been coming down 21, 22, 23. They have been continuing to come down in the first quarter of this year, and actually through March, there's been about 3.4 million ounces of ETF holdings liquidated, about 370 during March. Now, during March, what we saw was larger than 370 liquidations in the first half of March. As the price was rising, some of the investors who were in the ETFs were taking profits. Some of them were also continuing that long-term liquidation. And while that was happening in the physical market, there's no data on the physical market, we were seeing stronger demand. CPM Group expects investment demand to possibly exceed, get close to, if not exceed 30 million ounces this year. That'll be up from around 24, 25 million ounces last year in the physical market. Investors are buying very large amounts of gold worldwide in physical gold, but they're liquidating their ETF positions, or they have been until the second half of March. And that's probably not reflecting bearishness about gold. It's reflecting concerns about counterparty risk in ETFs. If you're holding physical gold, you're holding physical gold. Depending on how you're holding it, you have some counterparty risk. If it's being stored for you, if it's being held on an unallocated basis, even if it's being held on an allocated basis, but being stored for you someplace, there's some counterparty risk there. But with ETFs, you have increased counterparty risk with financial institutions that that manage and run and operate those ETFs. And what we've seen over the last 3 years and a quarter now is that investors are backing away from ETF holdings and they're turning more to other forms of physical direct ownership. That continued in the early part of March, but as the gold price continued to set new records and show greater strength in the second half of March, we saw investors buying into ETFs and ETF holdings actually rising. That represents short-term investors seeing record prices saying, I want to participate on the long side, and the easiest and quickest way for me to buy long exposure is to buy ETFs. So that's what I'm going to do. That's why we think it's probably a short-term phenomenon that you saw this reversal. Our expectation is that this decline that we've seen over the last 3+ years will resume over the course of the year, not because of bearishness or profit-taking in the precious metals market, but because investors are going to be probably more concerned about financial intermediary counterpart risk. These are Chinese ETFs, and you can see they've been rising for the last several months, and they continue to rise during March. So you've seen ETF buying in China. You've probably also seen physical buying there, although if you look at the Chinese and Indian investors, the premia that exist in the local Chinese and Indian markets, they are suggesting that physical investors in China and India prefer to buy low and are not necessarily chasing prices higher as they set new records. We're clearly seeing physical demand. It's not showing up in coins or other factors. Turning to silver, silver has lagged gold. It continues to lag gold, but really in the last few days, we've seen silver play catch up, and silver rose sharply on Monday, and then it rose even further. It's up 78 cents right now, so far today, around 25.85. Our expectation is that silver will continue to lag gold because investors are focusing more on gold and the dollar and U.S. Treasuries at this point. But we do see some upside for silver, both on a very short-term basis and over the next 1 to 3 months. And then longer term, we're more bullish on silver. Platinum prices, this could be a time to buy platinum on a short-term investment basis. We've seen the platinum price hammer down in January, and it was breaking below $800. Right now, the platinum price is, if I can find it, $937. There is the scope for it to rise a little bit further. And palladium prices also have risen. They're up about $10 today, although we don't necessarily see palladium as investment suitable for going long at this time. We launched our gold yearbook last week. You can buy a copy of it online. You can subscribe to the Precious Metals Advisory and get not only all those charts that I just showed you, but a whole lot of other charts. It's about a 40-page report, covers gold, silver, platinum, palladium, and rhodium, supply, demand, text, charts, tables, a lot of basic information that's accurate. We're not hyping. We're not paid to be bullish. We're paid to be accurate. The gold yearbook is out. You can buy that at our website, cpmgroup.com/store. The silver yearbook will come out in mid-May, platinum yearbook in mid-July. You can go to our website. You can read about a lot of free reads, free videos, free reports. You can buy reports, including the Precious Metals Advisory, the Base Metals Advisory, the yearbooks. You can pre-order the silver and PGM yearbook. And you can send us an email at info@cpmgroup.com if you want to talk about how CPM can help you either protect the financial position that you have in precious metals and commodities, or try to capitalize on it and get some capital appreciation there. That's all I have for now. Take care of yourself. Take care of those around you. Try to do some good in the world. And we'll talk to you later in the week.